You know, there are 4 words in investing that can cost you a fortune. We're about to dive into a story from market history that feels, well, eerily familiar today. It's a lesson that was paid for in billions, and it's one we might be about to repeat.
There they are. This time it's different. It's that little voice in your head when everything's going up and to the right. It's the mantra of every bull market, that cozy feeling that, the old rules just don't apply anymore.
But Sir John Templeton had a warning for us. He knew that nothing, and I mean nothing, will drain your bank account faster than that kind of blind optimism. And that's really the heart of what we're talking about today, that battle between the belief in a new era and the cold, hard lessons of history.
So to see what he means, let's hop in the time machine and head back to the late 1960s and early 70s. It was a time of, massive market optimism. You've got to understand, America was riding this incredible 2-decade-long economic high after World War II. The market had rocketed up over 350% since 1945. People felt unstoppable. They had money, they had confidence, and they thought the good times would just roll on forever.
And all that optimism, mixed with a serious case of FOMO, created a whole new investing philosophy. The idea was dangerously simple. Find companies that are so powerful, so totally dominant, that you only ever have to make one decision. Just buy them, and never ever sell.
And we're not talking about some speculative startups here. Nope, these were blue-chip, household names, the absolute titans of American industry. They got the nickname the Nifty 50, and to investors, they seemed completely bulletproof.
And this right here is the whole point. Whenever an investment looks like a total no-brainer, like it has absolutely zero downside, it's almost always hiding a huge risk. For the Nifty 50, that risk was sitting there in plain sight. They're absolutely insane valuations.
We can see this with something called the PE ratio. It's basically how much investors are willing to pay for $1 of a company's profit. And this is where things get wild. The average PE for the whole market was a pretty normal 15. But the Nifty 50, they were trading at an average of 42 times their earnings. That's almost 3 times the rest of the market.
And some were just off the charts. Polaroid, which was kind of the tech darling of its day, was trading at a mind-boggling 90 times earnings. Let that sink in. People were paying a price that assumed nearly a century of perfect growth all up front.
So what you had was this huge, systemic risk building up under the surface. At their peak, just these 50 stocks made up about 45% of the entire U.S. stock market. The fate of everyone's portfolio was basically resting on the shoulders of just a handful of companies.
And then the party stopped. Hard. The economic high that everyone was riding came to a sudden and really brutal end. It wasn't just one thing. It was everything all at once. An oil crisis quadrupled prices. Inflation exploded from 3% to 11%. Unemployment nearly doubled. It was the perfect storm.
The result? Between 1973 and 1974, the stock market got cut in half. A 50% drop. It was the absolute worst bear market since the Great Depression.
And what about those bulletproof stocks? Well, they weren't just corrected, they were completely obliterated. Polaroid lost 91% of its value. McDonald's down 70%. These one-decision stocks suddenly became one giant financial disaster.
But here's the real gut punch. This wasn't some quick dip and recovery. Nope. It took a full 8 years for the market to just get back to where it was before the crash. 8 years! Investors were stuck in this financial purgatory for the better part of a decade.
Okay, so why are we digging up this 50-year-old financial horror story? Because, as the saying goes, history doesn't repeat itself, but it sure does rhyme. And right now, the rhyme is getting pretty darn loud.
Just look at this. The parallels are just undeniable. Market concentration, 45% then, about 36% now. Extreme PE ratios, check. Polaroid's 90 looks almost quaint next to Tesla's 247. And that all-important one-decision stock mentality, it's back with a vengeance. It's the same script, just with different actors.
Instead of the Nifty 50, today we have the Magnificent Seven. 7 massive tech companies that are carrying the entire market on their backs. And they're treated like they can do no wrong, like they're just destined to grow forever.
Sound familiar?
And yeah, you guessed it. The valuations are once again acting like gravity doesn't exist. We're seeing PE ratios of 38, 50, and in the case of Tesla, a staggering 247. Now, are these fantastic companies? For sure. But are they priced for absolute perfection in a world that is anything but perfect? That's the billion-dollar question.
So, after all that, what is the one big lesson we're supposed to take away from this?
Well, maybe it's this classic line from Warren Buffett. The patterns are right there, the warning signs are flashing, but that siren song of "this time it's different" is just so incredibly powerful.
And that's where we are now. We're looking at a market that's incredibly top-heavy, where a lot of people are acting like crazy valuations don't matter, and we can all hear those four expensive words being whispered again. So you have to ask, are we next?
The lesson from the Nifty 50 isn't that great companies are bad investments. Of course not. The lesson is that even the greatest company on earth can be a terrible investment if you pay way too much for it. And the big question for all of us is, are we making that same very expensive mistake all over again?